July 15th could become one of the most important days for Canada's economy this summer. The Bank of Canada will announce its next interest rate decision and release its latest monetary policy report. Millions of Canadians are asking the same question. Will interest rates finally fall? But here's the truth. The interest rate itself may not be the biggest story. What the bank says about the future could matter even more. Let's begin with the current situation. Most economists currently expect the Bank of Canada to keep its policy rate unchanged at 2.25% on July 15th, rather than cut rates immediately. Markets are focused just as much on the bank's outlook for inflation, growth, and future policy as on the decision itself. So why isn't the bank rushing to cut? Because Canada's economy is sending mixed signals. On one hand, economic growth remains modest. Many households are still carrying high mortgage costs. Businesses remain cautious about investing because of global uncertainty and trade tensions. The housing market is recovering only gradually. On the other hand, inflation has recently moved higher, driven in part by energy prices and geopolitical events, although inflation is expected to ease again over time. The bank wants convincing evidence that price pressures are returning sustainably toward its 2% target before considering additional easing. And there is another major factor. Canada is navigating significant uncertainty surrounding future trade relations with the United States following the U.S. decision not to extend CUSMA for another 16 years at this time. That uncertainty affects business confidence, investment decisions, exports, hiring, and, ultimately, the Bank of Canada's economic outlook. The 5 things I'll be watching. On July 15th, I'll be paying attention to 5 questions, not just one. First, does the bank sound more worried about inflation or more worried about economic growth? Second, does it suggest interest rates could move lower later this year? Or does it indicate rates may stay higher for longer? Third, how much emphasis does it place on tariffs, trade uncertainty, and the global economy? Fourth, what does the new monetary policy report say about Canada's GDP growth, unemployment, and inflation over the next 2 years? And finally, fifth, does Governor Tiff Macklem sound confident or cautious? Sometimes one sentence from the governor changes market expectations more than the interest rate decision itself. So, will interest rates finally fall? Maybe. But perhaps that's the wrong question. The better question is, what does the Bank of Canada believe Canada's economy will look like 6 to 12 months from now? Because that's what determines where mortgages, housing, business investment, the Canadian dollar, and ultimately our economy are headed next. On July 15th, don't just watch the number, watch the message behind the number. That message could shape Canada's economy for the rest of 2026. I'll be watching the announcement live. Within hours of the decision, I'll break down exactly what it means for homeowners, buyers, investors, businesses, and Canada's housing market. Follow for clear, practical insights into Canadian politics, economics, interest rates, and real estate.